Social media contains numerous individuals providing tax advice. Most of this advice is incorrect. Some of them are illegal. The individuals providing this advice face no consequences when you follow it. You do, and this pattern repeats. Here are 10 common tax myths. They sound reasonable, they are not. The following explanations use basic mathematics and IRS regulations. Nothing here is controversial among actual people that aren't finance gurus. Anyway, just get an LLC. Social media frequently recommends forming a limited liability company for tax purposes. This is incorrect. A single member LLC receives the same tax treatment as a sole proprietorship according to IRS default rates. The tax forms are identical. The tax rates are identical, and the deductions are identical. Formation costs typically exceed $500. Annual maintenance fees vary by state. The tax benefit is zero. An LLC provides liability protection. This is a legal consideration, not a tax consideration. The two are frequently confused. After forming an LLC, individuals are told to deduct personal expenses as business expenses: cars, phones, travel. This violates IRS Publication 535. Deductions must be ordinary and necessary for business operations. Personal use cannot be deducted. Mixed use must be allocated and documented proportionally. A phone used 50% for business qualifies for a 50% deduction, not 100%. A vacation to Hawaii requires a primary purpose to be business. Documentation is required. The IRS has automated systems that flag disproportionate deductions. Audits occur regularly. Penalties include back taxes, interest, and fines. This is predictable and it happens frequently. Deductions reduce taxable income. They do not reduce spending. The mathematics are straightforward. If you are in the 32% tax bracket, a $10,000 deduction saves $3,200 in taxes. The expenditure remains $10,000. The net cost is $6,800 in the red. Spending $10,000 to save $3,200 results in spending $6,800. This is not saving a cent, this is spending. The terminology is misleading, but the arithmetic is clear. Homeowners are advised to itemize deductions for mortgage interest. The standard deduction for single filers is around 15,000 to 17,000. I forgot to check it this year, but it was 15,000 for tax year 2024. Average first year mortgage interest approximates $17,000. Itemizing requires total deductions exceeding the standard deduction amount. Mortgage interest alone is insufficient. Additional itemized deductions from medical expenses, charitable contributions, or state and local taxes must combine to exceed $15,000. Approximately 90% of taxpayers currently take the standard deduction. Itemizing increases preparation costs. Calculate the actual numbers for your itemizing and do not assume that it's always better. Retirement account contributions receive consistent recommendation regardless of individual circumstances. This ignores basic financial sequencing. High interest debt should be eliminated first. 22% credit card interest exceeds typical investment returns plus tax benefits. Emergency funds, however difficult they may be to acquire, should exist before retirement contributions. Without emergency funds, unexpected expenses require early 401k withdrawals. These incur penalties and taxes. The optimal sequence is to eliminate high interest debt, establish an emergency reserve, and then maximize retirement contributions. Context determines priority, and blanket recommendations ignore context. Tax refunds are perceived as benefits, they are not. A refund indicates overpayment of taxes during the year. The government held your money and they paid no interest. This is essentially an interest free loan to the IRS. A $3,000 refund represents $250 per month in excess withholding. This money could have been saved or invested or reduced debt. Instead, it has done nothing but line the IRS's pocket for a little bit. The optimal outcome is breaking even or owning a minimal amount. This indicates efficient tax withholding. Mortgage payoff, my apologies, is sometimes recommended for tax purposes. The recommendation is usually incorrect. Paying off a mortgage eliminates the mortgage interest deduction. Using retirement funds for mortgage payoffs trigger withdrawal penalties and taxes. The money withdrawn would have continued compounding tax deferred. Early 401k withdrawals create double taxation. Income tax is paid on withdrawal. The opportunity for tax deferred growth is permanently lost. This is tax inefficient in most scenarios. Specific circumstances may justify early payoff. Tax savings is not one of them. Trusts are promoted as tax elimination tools. This is incorrect. Trusts serve estate planning purposes. They facilitate asset transfer and provide liability protection. They do not eliminate tax obligations. The IRS has established rules for trust taxation, and these rules are comprehensive and enforced. Trusts can provide tax advantages in specific circumstances. These circumstances are narrow and require professional setup. Generic trust advice from social media is typically inaccurate or incomplete. Improper trust structures can trigger audits and penalties. Legitimate trust funds needs required qualified attorneys. Not a trust fund, just a trust in general. Travel deductions are frequently misunderstood. Attending a brief business meeting during a vacation does not convert the vacation into deductible business travel. IRS regulations require the primary purpose of the travel to be business related. Primary purpose is defined by time allocation and intent. Documentation requirements are specific. Itineraries, receipts, business purpose statements. The IRS audits travel expenses regularly. They have established case law distinguishing business travel from personal travel with incidental business activities. Violation results in disallowed deductions plus penalties. The prevalence of a practice does not establish its legality or advisability. Other individuals may be committing violations unknowingly. They may face audits in future years. They may have accountants who provide poor guidance. Social media examples have no evidentiary value. The IRS conducts audits continuously. Audit selection uses algorithmic triggers based on deduction patterns. Aggressive deductions increase audit probability. Penalties for improper deductions include interest, fines, and potential criminal charges in extreme cases. These consequences are real and documented. Social media tax advisors typically lack credentials. They are not certified public accountants. They are not tax attorneys. They are not enrolled agents. They create content for engagement metrics. Accuracy is secondary to views, and reliability is tertiary to views. These individuals face no liability when their advice causes audits. The tax burden falls on the person following the advice. Complex tax regulations are simplified into misleading sound bites. The viewer assumes risks, and the content creator assumes none. Hire a certified public accountant. Verify their credentials through state licensing boards. CPAs carry professional liability insurance and face board discipline for misconduct. They provide advice based on your specific circumstances rather than generic recommendations. Maintain comprehensive documentation. Follow IRS publications relevant to your situation. Avoid creative interpretations of tax code. Standard compliance is more cost effective than defending against audits. The IRS has decades of case precedent, and novel interpretations typically fail. The tax code is complex, and shortcuts do not exist. Social media oversimplifies for engagement. Consequences fall on the people that file the taxes and not the content creators. They use AI algorithms now. I hope you don't want to go through that. So, I forgot to do my slides correctly. That's my apologies. But anyway, yeah, guys, I'll see you guys next time. Peace out.